Our next
You're
guest
welcome.
warns
You're welcome.
Biden's new economic plan will put pressure on one of Wall Street's hottest trades. Let's bring in BofA's Savita Subramanian. She says it's time to dump tech, buy industrials on the back of the Democratic sweep. Savita, great to have you with us. Is this on the notion that there's going to be a lot more fiscal stimulus, more spending?
Yeah, I mean, I think really what we're forecasting is something different from what's happened over the last 12 months. And I mean, it's been really interesting listening to your comments over the last few minutes, because I think everything is spot on. We've got potential threats of inflationary pressure. We've got the idea that interest rates can actually move higher rather than grind lower, which is what we've seen over the last 10 years. So we've got this petri dish where everything that was good for tech and for secular growth is starting to change. Now, what I think is really interesting is the only thing that hasn't changed over the last 12 months, we have a new administration, we have a reopening, we have a vaccine. We have a whole bunch of changes in the macro landscape, but investor positioning has not changed at all. And that's what I find so remarkable, is that there is this really embedded tilt towards growthier tech companies, towards communication services stocks, still big overweight in FANG stocks. So I think that there is this reluctance amongst investors to acknowledge that we are setting ourselves up for a very different looking year. So, I think all of that paints a picture that could be very interesting and could also be painful for institutional investors. So here we are, we're looking at an environment where the leadership over the last 10 plus years are threatened by a lot of major and significant breaks in trend, like rates, like the dollar. A weaker dollar would benefit, energy, which is a sector that has really been in the doldrums for a very long time. So I think there are a lot of cross currents here, but what's remarkable to me is the embedded investor positioning in growth, tech, secular growth, and more of a defensive bias.
Savita, thanks for coming on. Do you have in your model anywhere an infrastructure plan, and what size, if you do?
It's probably a little too soon to say, but the way we adjusted our model to accommodate the idea of more infrastructure is the idea that the probability of an infrastructure bill went from 0 to positive with the outcome of Georgia, because under gridlock, we thought the stimulus bill, and an infrastructure bill in particular, was a non-starter. But under a more coordinated government, we think that infrastructure spend is more likely. On top of that, you've got sectors like, I think somebody mentioned Caterpillar earlier, but you've got these industrial bellwether or canary stocks starting to outperform the market again. And I think what that tells you is that even without an infrastructure bill, we could see just pent up manufacturing spend. And what I think is the reason we upgraded industrials rather than other cyclical areas of the market is I feel like 2020, even though it was a year of lockdown, global recession, horrific growth, we actually didn't really see a big stall in consumer spending. We saw consumption actually surprise to the upside, despite the fact that we were in a recession. But where we did see a complete paralysis was in the manufacturing sector. So I think those are the areas where even without infrastructure spending, we could see, a little bit of a rising from the ashes in that manufacturing, that manufacturing component of the economy.
Hey, Savita, it's Tim. Thanks for joining us as always. So your tech bleed story, something like Facebook today looks like it's more than a nick. In fact, this really looks like, it broke the 200-day for the first time since the way down through the beginning of COVID. And we're certainly seeing that in other parts of social media. I think we all know why. But could you see more of a barbell approach within tech? Semis made new highs today at a time when some of these trends that you're talking about for tech, though, are certainly front and center, and yet here we go there. So I understand where the Zoom trades are and some of these high multiple ones, but it does seem like tech's got a little bit of everything in there.
Tech has a little bit of everything. I totally agree with you. If you're going to be in tech, and you have to be in tech because it's such a big sector, go for the GDP sensitive kind of unit volume, sales growth plays like semiconductors. But, I don't think that's enough to keep the sector overall outperforming the market. So if you're looking at this on an industry by industry basis, I love the idea of semiconductors and some of the more GDP sensitive, even IT services coming back to life.
Yep.
But the overall sector, I think you've got too much of a growth tilt for it to actually outperform the market.
Savita, tonight, if you hear President-elect Biden talk about much bigger spending than you had anticipated yourself in coming up with your S&P targets, et cetera, does that change anything? Does that change?
Does that get us more bullish?
Does it get you more bullish? Does it hasten that rotation away from technology, for instance? I mean, how does it affect your forecast?
You know what? I think everything that we're hearing suggests to me that the economy is going to be great. But does that mean the stock market is going to continue to clip the same gains that we've seen over the last 10 years? I mean, I think here's what's interesting. The economy and the market have totally decoupled. So I think this is going to be a great year for the economy. And if Biden tells me that he's spending more than what I expected, that's even better for the economy. But whether that translates into the S&P running at that same hot level, I don't think so. I think there are a lot more interesting places to be right now, like small caps, like value over growth, which is a very small part of the S&P 500. So one of the reasons we're not that excited about the S&P is that it just doesn't have the stuff that's tied to this economic recovery that we're seeing very strong signs of, as well as this inflationary aspect that we're seeing building.
Savita, great to see you. Thank you.
Great to be on. Thanks.
Savita Subramanian, BofA. We're going to hear Biden tonight ahead of bank earnings season. And so I'm wondering, Dan Nathan, if that influences how you view those earnings. If he says, I'm going to spend much more money than you all think, should we expect yields to go higher and that bank trade to look even better?
Yeah, and listen, these guys, Tim, Karen, Guy, they've been all over that much more than my inclination over the last few months. But I'll just say this, about that spend that you're talking about, Mel. If we see a lot of money go to people's bank accounts that don't need it, like we saw last year, we saw the savings rate in this U.S. move up a bit. And where did a lot of that money go into? It went into some of those very speculative areas in technology with high valuations that are very stretched right now that Savita's talking about. So when we talk about this disconnect between the market and the economy, and we talk about this never-ending push for fiscal stimulus and obviously really easy monetary policy, that's how asset bubbles just inflate, and ultimately they will pop. When you think about how much was thrown at the economy and what that actually meant for the financial markets, some point the chickens have to come home to roost. I'm not saying that it ends today, tomorrow, that sort of thing. Bubbles can inflate for an awful long time, but if we see hundreds of billions of dollars go to people who don't need it and have no other place to put it other than in the stock market, beware, because you know what they're going for. They're not going for the banks and the industrials and that sort of thing. They're going for the stuff that they think is going to move.
Yeah. Tim, just quickly though, JPM, Citi, Wells Fargo, all report tomorrow. What will you be listening for on those conference calls?
Well, I think us, provisions coming off is maybe the biggest expectation and the driver that could surprise once again, because I don't think that the fourth quarter numbers in terms of their earnings are going to be that extraordinary for the money center banks outside of capital markets and investment banking and sales and trading. So FICC could be very, very strong. But the net interest margin benefits expectations off of a steeper yield curve don't happen in the fourth quarter. Also, let's be clear. I'm long Citibank, I'm long JP Morgan and Bank of America. Citibank's up 65% since November. It's very hard for me to see them announce anything tomorrow that's going to get you overly worked up. But I think the story on the banks and certainly getting some insight into the health of the broader economy, we'll all be listening for that. I think regional banks have less of a story to tell in banks' earnings than the money center banks, which I think have a couple levers to pull. But remember, markets have priced in some of those levers.
Shepard Smith here. Thanks for watching CNBC on YouTube.